All right, welcome to the September 16th supplemental part of the lecture for 3.3. We'll talk about depreciation accounts being the third type of account we need to make an adjusting journal entry for. So depreciation expenses, what are those? Well, technically there are technically that these are also like deferral type expenses. We paid cash for equipment like our laptop. We paid for it first, but over time we need to expense it. We expense it later. So these are kind of like, when you think about long-term assets, they're essentially like deferrals in that we expense things, but we expense things over long periods of time. This requires the use of what's called a contra asset account, which has a normal credit balance. We do not directly decrease our property, plant, and equipment expense accounts. We want to set up a separate contra account to show all the theoretical wear and tear into these accounts. Which accounts do we use for depreciation? Well, in long-term assets, there's really only one type of an account. It's usually called accumulated depreciation. So there will be an accumulated depreciation for equipment. If we have a building, there would be accumulated depreciation for that building. Anything that's depreciated over time, we will set up a contra asset account to record its theoretical wear and tear. The assets, long-term assets, usually have a debit balance. These contra asset accounts have a normal credit balance. When we net the long-term asset account against the accumulated depreciation account, we get net book value. So depreciation, we have to ask ourselves, what is the unadjusted balance per the unadjusted trial balance? Well, currently, accumulated depreciation for equipment doesn't even exist. Usually, most businesses have some balance in there because they have been using their equipment. But the reason why we don't have something in there is because, hey, it's probably new equipment. So we have to be very diligent and potentially have to add in an account line item just to record this type of adjusting journal entry. So the question then comes down to, what am I missing? Well, look around the office or the warehouse. If you're sitting in a chair or you're using a desk, that's office equipment. That's probably needs to be depreciated. If you're using computer equipment, that needs to be depreciated. Things like that. If you own property, any type of property, it probably needs to be depreciated. Does a balance need to be updated? Always does, always. And the thing we need to be aware of is that these expenses happen just because of the passage of time. So assume we have equipment purchased on June 3rd for $24,000. It has a 5-year life and a zero salvage value. So take the $24,000 amount we paid for it, divided by 5 years. That means every year we need to record $4,800 in depreciation expense. But be careful. We only have incurred 1 month for June. So 4,800 divided by 12 is 400, or 1/12 of 4,800 is $400. That's how much depreciation was incurred during the month of June. So we're going to debit depreciation expense for equipment for that amount and credit not the equipment account, but its contra account accumulated depreciation for 400. And then we record a memo entry for depreciation expense. Then, as usual, we post things directly to the ledger and we update the account balances. So why do we use a contra asset account to record depreciation? Why don't we just directly reduce the equipment account? Well, the answer is kind of pretty straightforward. Depreciation is theoretical. We don't really see it. It's kind of hard to verify it objectively. We know that it exists. Wear and tear happens on equipment, on buildings, things like that, on vehicles, right? Office furniture. We know that things break or just break down over time. We just can't determine the amount of how much that wear and tear is exactly. So we discuss more about that in Chapter 7. We talk about long-term assets and depreciation. For the time being, just realize that when it comes to reporting these long-term assets on the balance sheet, we generally leave the amount that we paid for equipment alone. We don't adjust that account directly. If there is wear and tear, we record the historical wear and tear in the accumulated depreciation account, and we show that right below the equipment account. So that way, when we report the value of equipment, we show it as net book value. This 23,600 is net book value. The 18,000 in land plus the 23,600 net book value gets us total plant assets, total long-term assets of 41,600. Note that we do not depreciate land. Land generally appreciates over time. So here's a summary of all the different adjusting journal entries we just walked through. And it's kind of useful to kind of go through and see what those different things were. In our journal, we would show all these different entries, and then we would see in our ledger all these individual updates or adjustments to the account balances. So there's accounts receivable, there's that adjusting journal entry for adjusting journal entry E, supplies, there's that supplies reduction. The E ties over to the E in revenue down here. The supplies expense, the credit here 300, that ties over to supplies expense. And prepaid rent, there's A, that credit reduces prepaid rent, and then it shows up as rent expense. So realize that what we see here are the resources that end up being consumed. Assets, most assets are essentially deferred expenses. We pay money for things. They're essentially prepaid items that will be consumed over time. So there's supplies shifting over from supplies over to supplies expense. There's prepaid rent being shifted over to rent expense. There's accumulated depreciation, which offsets equipment, showing up as depreciation expense. So the asset side is going down. When assets or the resources are being consumed, the consumption is represented as expense. The expense is the vapor trail of using up our assets. We also show in the adjusting journal entries the obligations are rising from consumption. So even if we're not paying cash or using some other asset to represent this consumption, we may be consuming an expense that has not yet been paid for. That's why we don't bother with assets. We may have to go over to the liability side and say, oh, we need to pay somebody for these expenses. We will utilize later cash to pay off the salary payable. But for right now, it's a liability. The consumption is represented on our income statement. Again, later, cash will be used to settle off this payable. Income tax is payable. Haven't paid that yet, so we owe the money. Nevertheless, I have consumed, if you will, that tax expense. Taxes basically being we're paying our federal government for protecting our currency, our infrastructure, and our borders. The effort given, that's the revenue there, is in exchange for fresh resources. So I've earned some revenue that wasn't previously recorded. I need to update my account balances for that. Sometimes the effort I've given is in exchange for some type of debt relief. So realize that unearned service revenue is a liability, and I owe that money back to somebody unless I perform those services. So if I put forth the effort in terms of services, I get to record that as revenue and reduce my liability. I get debt relief from performing services. In the final steps of updating the trial balance, you have to realize that there are two columns. There's the unadjusted column on the far left here, and then all of our adjustments from our adjusting journal entries are reflected in the adjustments column. So as we go through this, realize that all these different journal entries that we have posted to the ledger have to also be included in our trial balance under the adjustments column. So accounts receivable, we updated that with a debit for 300. Service revenue, we did a credit for 300. So those go in the debit and credit columns respectively on the trial balance under the adjustments column. Supplies, we consumed supplies of 300. We therefore updated our supplies account for 300. We consumed rent. We had to adjust our prepaid rent asset. We've utilized our equipment. Therefore, we need to reduce, albeit indirectly, our equipment account. Equipment is left alone. We just use a separate account to keep track of the theoretical wear and tear. People have worked for us. We've consumed their benefits in the form of salary expense, but we haven't paid them yet. So instead of crediting cash, we need to credit a payable. Some unearned revenue has been earned. How did we earn it? By putting forth effort. We have to pay taxes, unfortunately, but if we don't pay them in cash, if we have not paid them in cash, then we owe them as in the form of a liability. Now, as a third step, notice how we have the unadjusted, the adjustments. Now we have the third and final set of columns, the adjusted trial balance. This is the granddaddy of them all. This is what we want to use to help us produce the financial statements. What we're going to do is crossfoot. I know that sounds weird, but that basically means adding a cross. But you want to be careful about this now. You're not just simply adding numbers left to right. You're adding debits to debit balances, or you're subtracting debits from credit balances. So in this case, we see that accounts receivable, 2,200 is a debit balance. Let me back this up here. Accounts receivable is a 2,200 debit balance. We are adjusting it with another debit. So this debit balance is being debited again, which increases it to $2,500. So this is, take this debit, add another debit, gets us a higher debit balance. But when you look at supplies, it's a debit balance. We are crediting that account. Therefore, the balance is now adjusted downward to 400. Be very careful when you're adding these across. If it's a normal credit balance, then any adjustment that's a credit needs to be added to that credit balance. If it's a normal credit balance, but we're debiting an adjustment, that debit needs to be subtracted from the credit balance. So again, why do we use debits and credits? If we didn't do debits and credits, we would screw up this math royally right here. So hopefully you can have a bigger appreciation for debits and credits, because there's a lot of stuff going on here. If we add or subtract things incorrectly, these things will get all shades of screwed up. But realize this as well, back up here a second, that we still need to check each column to make sure the debits equal the credits. $3,700 in total debits and credits adjustment, and we have $91,500 total debits and credits in the adjusted trial balance. Things are looking pretty good. It looks like we have done our work correctly. If we haven't, if these things are screwed up, then we need to go back and fix those things. Oftentimes, these things don't balance because we put our adjustments in the wrong column, or we added them across incorrectly. So go back and make sure you've done this tedious part of accounting properly. Also notice that the adjusted trial balance needs to agree with the ledger balances. So for example, I'll just use a handful here. The adjusted trial balance, when we're all said and done, we see that accounts receivable is now $2,500. Does this tie back to the ledger? Yes, it does, $2,500. What about, for instance, salary payable? Well, the final number says here $900. Does that agree with the ledger balance? It does. What about service revenue? Have we done that correctly? Yep, there it is, $7,500. Total income tax expense, debit $600. Yep, that has a debit balance. So you can see that it's another tedious check to make sure that we've done things correctly. Another way to check to see if we've done things correctly is to look at, compare the total debits and credits from the adjusted trial balance to the total debits and credits in the ledger. So when you add up all the debits, you get a total of $91,500. Add up all the credit balances, $91,500. That ties back to what we see on the adjusted trial balance. It looks like we've done things fine. That's it for 3.3.